This is Mark to Market, a podcast of BT Correspondents.
Hello, everybody. Welcome to Mark to Market, a BT Correspondents podcast that aims to provide analysis and insight on market trends and corporate issues in Singapore. My name is benpaul, and I'm a senior correspondent at the Business Times. Every week, my colleagues and I delve into a business story that matters. We're in the month of June 2025, and there's been a lot of talk recently about the seemingly unending string of companies choosing to delist from the Singapore market. Among them are companies as diverse as nursing home operator Econ Healthcare Asia, technology products distributor Ban Leong, and Indonesian property group Sinamas Land. However, some real estate investment trusts, or REITs, are also choosing to go private, which, while not completely unheard of, is sort of unusual. REITs are one of the most popular segments of the market, in part because they are designed to deliver the bulk of their total return through cash distributions, which local investors love. Moreover, REITs are very relatable, especially those focused on the Singapore property market. Investors can actually see and experience the shopping malls or hotels or office buildings held by these REITs and form their own opinion about how these assets are performing. In fact, one of the REITs that's going private is Paragon Reit, which, as its name suggests, is the owner of the Paragon on Orchard Road. Its other assets include the Clementi Mall and the Westfield Marion Shopping Centre in Australia. Now, under the trust scheme of arrangement for Paragon's privatization, investors were offered 98 cents per unit, which was equivalent to 1.07 times its adjusted net asset value, or NAV. When the scheme resolution was put to a minority investor vote in April, it was approved by quite a wide margin, and SGX has already given its approval in principle for the delisting, so this is a done deal. The other REIT that's possibly headed for a delisting is Frasers Hospitality Trust, or FHT, which owns the Intercontinental Hotel located next to the Bugis Junction shopping mall. Under a trust scheme of arrangement similar to that of Paragon Reit, announced just a couple of weeks ago, minority investors are being offered 71 cents for each staple security they hold in FHT. This is equivalent to 1.11 times FHT's adjusted NAV. Now, FHT's sponsor group narrowly failed to take it private back in 2022 at 70 cents per staple security, when the whole hospitality sector was still reeling from the effects of the pandemic. So there is a sense among some investors that they're being lowballed by the current offer of 71 cents, even though it's quite a good premium to NAV. So it'll be interesting to see how they eventually vote. I'll talk more about whether they should accept the offer or not later in this podcast. But let me first get on to the rationale put forward by Paragon Reit and now FHT for going private, and whether it's just a matter of time before more REITs follow their example. When Paragon Reit's manager unveiled plans to take it private in February of this year, it mentioned many of the things that are usually said in these situations. For instance, there's limited investor interest in the REIT, and trading liquidity has been very low. But the manager also said that taking the REIT private would pave the way for a much-needed Major Asset Enhancement Initiative, or AEI, at the Paragon on Orchard Road. That single property accounts for 72% of the appraised value of the REIT's property portfolio, and it could soon face heightened competition from properties in the area that are being upgraded or redeveloped, including the likes of Ming Arcade, Forum the Shopping Mall, and Tanglin Shopping Centre. The manager said the cost of this AEI could be as much as 21% of the appraised value of the Paragon and take as long as 4 years to complete. So this will probably have a big impact on Paragon Reit's ability to maintain its cash distributions. This is something that REIT investors tend to overlook. They often think of real estate, especially in Singapore, as a source of unending cash flow, and REITs play to that perception by paying out nearly all of their distributable income. But the reality is that shopping malls, offices, hotels, and even industrial properties need reinvestment over time in order to maintain their attractiveness to tenants and keep their revenues growing ahead of escalating costs. This is a risk that all REIT investors ought to keep in mind. In a similar manner, When FHT's manager announced its privatization plans, it highlighted a number of macroeconomic trends and structural factors that could prevent it from growing the hospitality trust's cash distributions and NAV. In particular, the manager said higher interest rates since the COVID-19 pandemic have increased FHT's debt costs and weighed on the market value of its staple securities. The relative strength of the Singapore dollar has also adversely affected FHT's DPS and NAV because 59% of its nearly $2 billion property portfolio is located outside of Singapore, in Australia, Japan, Malaysia, and the United Kingdom. Then there's the general volatility of the hospitality sector, the rising costs of running its hotels, and the periodic capital expenditure necessary to maintain the attractiveness of these hotel properties. FHT's manager is not just imagining these risks. The long-term performance of hospitality trusts in Singapore has actually been relatively poor. Since FHT was listed in July 2014, up to the day it announced a strategic review in April, Singapore-listed hospitality trusts achieved an average annualized total return of just 0.79%. In the wake of this weak performance, the market valuations of hospitality trusts have naturally eroded. FHT traded at an average of 0.95 times NAV during the period spanning its listing in July 2014 up until March 2020. Its peers, namely CapitaLand Ascott Trust, CDL Hospitality Trust, and Far East Hospitality Trust, traded at an average of 0.89 times NAV during the same period. But if you look at a more recent period, from May 2023 to April 2025, FHT traded at an average of only 0.73 times NAV, while its peers traded at an average of 0.72 times NAV. FHT's manager said last month that a number of options were considered to unlock value for investors. These included boosting the yields and valuations of FHT's existing properties through AEIs and scaling up FHT through a big merger or acquisition. In the end, however, it was decided that exiting the public market made the most sense. Many investors in Singapore might find all of this rather disheartening. With hospitality trusts in the local market suffering weak returns and sagging market valuations, is it just a matter of time before some of FHT's peers also decide to give up trying to expand and simply go private instead? Given that FHT's efforts to expand its property portfolio to markets like Australia, Japan, Malaysia, and the UK have backfired because of the strong Singapore dollar, what is the future for Singapore's REIT sector? Is it just going to be a handful of Singapore-focused REITs that dominate the whole market? And as more and more aging properties in the small Singapore market eventually require updating and refurbishment, like the Paragon, wouldn't investors in all but the very largest local REITs face weaker returns and increased risks? What does all this mean for the vibrancy of Singapore's REIT sector in the future? I'm going to talk about that next.
Money Hacks by the Business Times delivers useful financial tips every Monday. Subscribe to the playlists in Spotify, Apple Podcasts, or wherever you listen to podcasts. But if watching is your thing, we've got you covered. Subscribe to the Money Hacks playlist in the podcast tab of BT's YouTube channel and watch as Howie Lim gets the inside scoop on the best money hacks. Subscribe and watch today.
And now, back to Market, a podcast of BT Correspondents.
Investors often don't remember the REITs that have gone private because most of those REITs didn't really make much of an impact while they were listed. Among the REITs or business trusts that have delisted since the pandemic were Soilbuild Business Space REIT and Accordia Golf Trust. Looking further back to before the pandemic years, a couple of Japan-focused trusts delisted, namely Saizen REIT and Crisis Retail Trust. But there have been quite a number of more well-known REITs that have disappeared from the local market, not because they delisted, but because they were acquired and subsumed by other REITs. This was driven by their sponsor groups wanting to enlarge the REITs within their stables, as well as by changes in the business strategies of those sponsor groups. For instance, the largest Singapore-listed REIT, CapitaLand Integrated Commercial Trust, was previously called CapitaLand Mall Trust, and it was renamed after acquiring CapitaLand Commercial Trust. So two relatively large REITs merged to form an even bigger REIT. In another case within the Capital Land Group, what is today called Capital Land Ascot Trust acquired Ascendas Hospitality Trust just before the pandemic. That merger came right after Capital Land's acquisition of Ascendas Singbridge, so two sponsor groups merged and consequently their REITs merged. In a similar case, right after ESR Group acquired ARA Asset Management, two REITs within their respective folds merged. ESR REIT acquired ARA Logos Logistics Trust and for a period of time renamed itself ESR Logos REIT before reverting to just ESR REIT late last year. Now, these deals didn't always go smoothly. For instance, minority unit holders of Sabana Industrial REIT managed to block an attempted merger with ESR REIT, and that resistance seemed to snowball into an eventual push for Sabana REIT to internalize its management function. In another case, minority unit holders of Mapletree Commercial Trust and Mapletree North Asia Commercial Trust resisted their proposed merger, to the point that Mapletree Investments, the sponsor group behind those two REITs, eventually stumped up $2.2 billion in cash to sweeten the terms for everyone. After Mapletree Commercial Trust subsumed Mapletree North Asia Commercial Trust in that deal, it was renamed Mapletree Pan Asia Commercial Trust. My point in all of this is that the privatization offers for Paragon Reit and FHT shouldn't be viewed in isolation. REITs and the sponsor groups behind them are constantly adapting to the changing dynamics of the property sector and trying to find new opportunities to build a wider investor following and expand their property portfolios. While it might make sense for some REITs to exit the public market at any given time, it doesn't necessarily mean that the whole REIT sector will shrink. As some REITs exit, a crop of more interesting new REITs will probably come to market, and many existing REITs will keep expanding as the cycle turns more positive. In fact, this could be an interesting moment for Singapore's REIT sector. In the first half of this podcast, I mentioned that FHT and its hospitality peers achieved an average annualized total return of just 0.79% from July 2014 until April of this year. This is quite disappointing, of course, but it's worth pointing out that most of Singapore's REIT sector didn't perform all that much better. According to the presentation deck provided by FHT's managers, Singapore-listed commercial property REITs returned an average of just 3.61% per year during the same period. Industrial and logistics REITs returned only 4.92% a year. The best performance really came from what they call specialized REITs, such as Parkway Life REIT and Keppel DC REIT, which achieved an average annualized total return of 10.07% during the same period. Against this backdrop, it's perhaps not surprising that the crop of new REITs reportedly coming to market are focused on these relatively hot sectors, such as data centers, healthcare assets, and student accommodation, while commercial and hospitality property trusts like Paragon Reit and FHT are being taken private. But here's the thing, while the micro fundamentals of individual REITs were certainly a key factor in their long-term performance, the pandemic and subsequent rise in interest rates were a big factor in the performance of all REITs right across the board. If you just eyeball the price charts of various REITs, they all dipped very sharply in early 2020 when governments everywhere imposed pandemic control measures, before quickly rebounding to varying degrees as the crisis waned, and then falling gradually from late 2021 onwards as inflation took off and interest rates began rising. Now, although there's still a lot of global economic uncertainty out there, with the US government imposing stiff import tariffs on just about all its key trading partners, many market watchers are expecting interest rates to keep falling in the months ahead. And the way I see it, this could gradually create a tailwind of sorts for the whole REIT sector. In a recent report, RHB said nearly 3/4 of the REITs under its coverage saw flat to moderate interest cost declines during the first quarter of this year versus the previous quarter, with Singapore-focused REITs seeing the largest drop in interest costs. With the exception of REITs exposed to the tough US and China markets and the hospitality and office sectors, most REITs under its coverage also experienced stable occupancy rates and positive rent reversions. RHB also said that REITs have seen their yield spreads widen this year thanks to falling yields on deposits, T-bills, and Singapore savings bonds. The research house went on to say that it is positive on large-cap, Singapore-centric REITs. It prefers those exposed to the industrial, office, healthcare, and suburban retail subsectors. Among the picks it named in its report were CapitaLand Ascendus REIT, CapitaLand Integrated Commercial Trust, Fraser's Centrepoint Trust, Ames APEC REIT, and Keppel REIT. This brings me back to the question of the likes of Paragon Reit and FHT going private. While these delistings might raise questions about the future of the REIT sector, my view is the expectation of more such deals could actually boost investor sentiment in some of the weaker segments of the REIT market. The big question is whether investors are adequately compensated by the offerers when these deals happen. In the case of FHT, as I mentioned earlier, investors are being offered 71 cents per stapled security, which is equivalent to 1.11 times FHT's adjusted NAV. This is higher than the average 1.04 times NAV at which precedent REIT privatizations since 2020 were priced, and it's well above the 0.62 times NAV at which hospitality trusts trade in the market. The offer price of 71 cents per stapled security also implies a total return of 27.8% for investors who bought FHT at its initial public offering in 2014. FHT's peers delivered total returns over the same period ranging from minus 6.3% to 24.5%. These metrics suggest to me that FHT's minority investors are being quite fairly compensated in this privatization exercise, even after taking into consideration the potential tailwind of lower interest rates later this year. Of course, investors will always want to be paid more, and some market watchers may remember that minorities of Croesus Retail Trust were paid a nearly 20% premium to NAV. But it should be noted that the acquirer in that instance was private equity firm Blackstone, whereas the acquirer in the case of FHT is Fraser's Property, a listed property developer whose own shares are trading at a more than 60% discount to NAV. So, under the circumstances, Fraser's Property could be hard-pressed to justify a much higher offer price to its own shareholders. The way I see it, FHT's minorities should accept the offer and reinvest the proceeds in some of the biggest Singapore-focused REITs in the market. Over the long term, it's likely to be these big Singapore-centric REITs that are best positioned to ride through the upcycles and downcycles ahead. That's it for this edition of Mark to Market. BT Correspondents will be back next week with wealth editor Genevieve Kwok, so please keep listening. If you have any thoughts or questions about the show, email us at btpodcasts@sph.com.sg. I'm benpaul. As always, thank you for listening and join us again next week.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.